James lives in a working-class neighborhood in Cleveland. Despite steady employment, he has never had a bank account. Instead, he cashes paychecks at a check-cashing outlet, losing 2% each time. He pays bills with money orders and stores cash at home, facing extra fees and risks. James represents millions of unbanked Americans. Research by economists Claire Sellerier and Adrien Matray shows about 30% of low-income Americans don't have bank accounts. While poverty is often tied to income, their study reveals that lack of financial access itself can trap households in poverty. Financial inclusion is not just about convenience, says Matray. It's a fundamental tool for wealth accumulation and mobility, especially for low-income households. The wealth-building power of bank accounts. Published in the Review of Financial Studies, their research found that low-income households with bank accounts accumulated about $6,900 more in assets than those without. This wealth gap wasn't explained by income. Banked households earned only 30% more income, but had over 4 times the wealth. The findings suggest that financial inclusion creates a multiplier effect on wealth building. Bank accounts help households in 3 major ways. First, they provide a safe place for savings, allowing compound interest to build wealth. Second, they make it easier to invest in durable assets, especially vehicles. Banked households were 56% more likely to own a vehicle and invested about $5,900 more in them than the unbanked. Reliable transportation expands job access and earnings. Third, accounts improve credit access, helping households secure affordable loans instead of relying on costly alternatives. A buffer against hardship. Perhaps most importantly, the researchers found that financial inclusion provides a crucial buffer against economic shocks. When households experienced job loss, those with bank accounts were significantly less likely to face financial strain than unbanked households experiencing the same hardship. The difference in financial resilience was striking, Matray emphasizes. While the probability of financial strain increases around 50% for unbanked households after a layoff, it remains stable for households with a bank account. This suggests that banking services give low-income households tools to manage their personal finances and maintain a financial cushion that absorbs negative income shocks. This finding underscores a critical but often overlooked dimension of financial inclusion. It doesn't just help people build wealth during good times, it also helps them preserve that wealth during difficult periods. The supply side problem. So why are so many still unbanked? Sellerier and Matray point to access. When states loosened interstate banking regulations, branch density in poor counties rose 20%, and more low-income households opened accounts. The evidence suggests people aren't avoiding banks by choice, but because services aren't accessible or affordable. Beyond individual benefits. Financial inclusion. Benefits. Entire communities. Banked households are less likely to fall behind on rent, helping landlords and stabilizing neighborhoods. They also maintain spending during downturns, supporting local businesses. The ripple effects make inclusion a community asset, not just an individual one. The path forward. The study offers clear lessons for policymakers. First, expand access by encouraging banks to serve underserved areas or by supporting mobile banking. Second, reduce barriers like high fees and minimum balances that discourage low-income households. Third, promote financial education to highlight the advantages of mainstream banking over high-cost alternatives like payday lenders. A foundation for mobility. James's story illustrates the impact. When a local bank offered no-fee accounts, he signed up. Within 2 years, he saved enough for a reliable car, boosting his job prospects. With direct deposit, he built regular savings. His journey reflects what the research confirms. Financial inclusion gives people the tools to build stability and opportunity. Returns to financial inclusion among low-income populations are high, Matray concludes. The unbanked are constrained by supply, not by choice, and they benefit greatly once included. As banks and policymakers work to expand access, they aren't just opening accounts. They're opening doors to security and upward mobility. In a society with widening inequality, ensuring everyone can access basic financial services is essential for building a fairer economy.